In this week's video, we'll review the latest charts and data to help us understand why, despite numerous legitimate concerns, the bulls still control the long-term trend. We'll be moving quickly, so feel free to use the pause button on your video player. 100% of this week's video is being recorded at 2:45 p.m. Eastern Time on Friday. This week's video will focus on longer-term trends. Numerous short-term issues are addressed in this post here dated September 26. You can find it by Googling the title on your screen and the name of our blog, Short Takes. On Thursday, we closed 67 points above this gap and bounced from an extremely rare oversold level. After something similar in 2003, the S&P 500 was 36% higher a year later. 2011, after something similar, over 18% higher a year later, and in 2018, approximately 34% higher. Simply telling us to keep an open mind about longer-term outcomes that are better than expected. In this case, it took a couple of months for the market to really right itself in 2003. Same can be said for 2011. It was rocky between August 4th, 2011 and early October 2011, but things improved considerably over the next 10 months or so. Out of these three cases, the 2018 case is the only case where, for the most part, this was the low and the end of the volatility. Like all forecasts, the further we go out on the interest rate calendar, the more uncertain expectations become relative to reality. Thus, it's best to focus on near-term changes in rate expectations. Relative to the last Fed meeting and Powell's press conference, interest rate expectations have improved. Pre-Powell, 74%, roughly 83% today. December, 61%, roughly 66% today. January, pre-Powell, 61% today, roughly 66%. That speaks to the probability that interest rates will remain unchanged between now and January's meeting. As we've discussed numerous times in recent videos, there are a lot of legitimate concerns in the present day, and many of them are related to the enormous amount of debt in the global system, fueled by ultra-low rates and easy money, and deficit spending from governments around the globe. Since it's easy to understand how a major recession could occur, and major recessions typically lead to very large drawdowns in the stock market, in this week's video, we'll take a look at the intermediate to shorter term picture using facts, and do the same relative to the stock market and economy's longer term outlook. We've made some significant progress in the tedious process of secular trend modeling, which will be covered in the next segment of the video. This is the anchored volume weighted average price chart that we covered back in August, I believe on August 18th and August 25th. And we said, based on everything we knew at that time, it wouldn't be shocking if the S&P 500 dropped approximately 6% from this peak here, 8%, let's say 10% to 12%, and maybe even as much as 15 or 16%. And the primary reason for covering this chart back in August is so we would have logical reference points. If we look at the exact same chart during the session on Friday, September 29th, it's very difficult to say we've seen anything yet that's particularly shocking relative to what we talked about back in August. Thus far, the S&P 500's had approximately an 8% drawdown. And put that 8% figure in your back pocket because we will reference it later in the video. Bearish concerns would increase if price moves into this area here, and even more so if we took out this March low here relative to price and these anchored volume weighted average price bands tied to the COVID low and COVID high. That absolutely, positively may happen, and it may happen very, very soon, but it hasn't happened yet. And the purpose of a chart like this is to help us make rational decisions under stressful circumstances. Before we review the longer-term charts, it's important to keep in mind the markets are thinking about all relevant topics. That includes concerning topics, and it also includes favorable topics. You can't evaluate the market by just looking at the negatives in isolation. It's the beauty of the charts. It's the beauty of markets. They take all of the known information, all of the expectations about the future, on any time frame that you can think of, and relative to any topic you can think of. All of that is reflected in price. And common sense tells us if a severe recession was right around the corner, or a major debt crisis was right around the corner, it's not likely that the market's longer-term profile would look like this or this. And it's more likely that it would look something like this or this. And as we've noted in the past, one of the ways to differentiate between a period of secular stagnation or a pre-crisis look and a secular bull market is to focus on the interaction of price, the 10-month moving average in blue, and the 40-month moving average in red. Within the context of a secular trend, the market tends to make a stand near an upward-sloping 40-month moving average. Contrast that with price slashing through the 40-month moving average in 2001, price slashing through the 40-month moving average in 2009, price slashing through the 40-month moving average in 1969, and price slashing through the 40-month moving average in 1970. And all of this is relevant from a timing perspective because markets are discounting mechanism. They're always looking to the future. And when we get negative setups like this setup here in 2008, it's not unusual for significant additional drawdowns to occur within the context of a crisis. In this case, the S&P 500 lost an additional 46%. In the 2001 case, the additional loss from point A to point B, 37.44%. 1969 case, an additional loss of 26.54%. And prior to this crushing leg down in 1974, the market had this concerning setup on March 27th, 1974, that was followed by an additional loss of 35.52%. So if a severe recession was right around the corner, it's prudent to be concerned, because after the four setups that we just covered, the median additional loss in the S&P 500 was over 36%, and that occurred over the next 188 calendar days. And that could mean in 2023 and 2024, the S&P 500 could fall to approximately 2,800. Thus, if we're going to use charts and data properly in this environment, we have to be able to objectively ask, in the present day, do we have a setup that's more in line with a long-term secular trend, or a setup that's more in line with an imminent crisis? More specifically, does the present day look more like 1994 or 2008? And we can ask the same question about 2001, 1969, and 1974 objectively using the secular trend model. Scores range between 0 and 100%. The lower, the more concerned we would be. The higher and closer to 100%, the less concerned we would be. Thus, if the present day looks like this or this, we would expect the present day score to look like this, 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 or this. So let's forget about the fear, let's forget about the emotions, and let's forget about our personal bias. What was the score on September 29th, 2023? The answer is 87.18%, which really doesn't look anything like the median score over here of approximately 18%. And remember we said to keep this approximately 8% drawdown in your back pocket? We wanted to know, within the context of a secular trend, when you had significant drawdowns. So here are the four cases we picked: 1990, 1957, 1962, and 1966. The average drawdown within the context of a secular trend was 23%. And on this day, this day, this day, and this day, we were approximately 8.5% from the prior peak, which would be similar to September of 2023. This score was generated by the current version of our prototype, as were these scores down here. The average score in these 4 periods was 48.2, significantly weaker than 87.18, simply telling us that the net aggregate opinion of all market participants regarding all subjects on all time frames, and that includes these legitimately concerning bullet points, and it includes the favorable long-term demographics. It's very, very possible we're going to see additional deterioration, but based on what we know today, September 29th of 2023 is in better shape than August of 1990, August of 1957, April of 1962, and May of 1966. And in all of these cases, the additional drawdown, even within the context of a secular trend, was significant. How about from a visual perspective? We've been talking about charts with the 40-month moving average and the 10-month moving average in blue. We said this was the type of look that we would want to avoid, the look in 2008. And this would be the type of look that we would want to embrace, where the 10-month moving average comes down and kisses an upward sloping 40-month moving average, price recaptures the moving averages, and the secular trend resumes. Thus, once again, let's objectively ask and answer, does the present day look more like 1988, 1990, 1994, or 2001? It's probably fair to say on September 29th, 2023, with a setup that features a 10-month moving average that came down near an upward sloping 40-month moving average, kissed it, and then turned back up. And now we have a situation where price has recaptured both of the moving averages and the slopes are up. If we review the chart objectively, it's fair to say this looks a lot more like these periods denoted with the blue boxes, and a lot more like 1953 and 1960 relative to these major crisis setups where extremely painful additional drawdowns occurred. This issue has been and will continue to be on our radar. And we all know, if we're going to try to size up the entire market and its trend objectively and discern between a look like this, a look like this, and a look like this, or a look like this, the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.